Thing number one, Gary, we're heading for a debt crisis, and that's not counting BNPL, which we've talked about in previous editions of the five things. Gary, thing number one, an American debt crisis.
Thanks, Rob. So, one big theme here on deep knowledge investing that we've talked about on this show for about 2 years is a bifurcation in the American economy. What we've talked about are a small number of people who have portfolios and assets and credit scores that position them to do really well in inflation. So, think about it for a minute. We've all seen the price of assets go up. And if you had the wherewithal in your household to do things like take on debt and buy a house, take on debt and buy gold, to buy Bitcoin, to buy stocks on margin. You were short the US dollar, which has been declining in purchasing power, and you were long hard assets, which have all gone up because of inflation. Now, for those few people who have been able to do that, it has been a great economy. But for the rest of the country, they have been struggling. Inflation is horrible for most families. It just makes it difficult for people to pay their bills, and a lot of the country is struggling. And over the last couple of weeks, last couple of months, we have started to see that in some of the debt statistics. And so recent data has shown US credit card, auto loan, and commercial office defaults are peaking to levels we haven't seen since the great financial crisis. And this is a gigantic problem. Now, listen, these things wax and wane, they go up and they go down, but anytime you start to see huge spikes in defaults or delinquencies, you have a problem because those people are not going to pay their bills, and that's going to create a problem for the people who lent to them. We saw in the third quarter over $24 billion in credit card balances added. That's up 8% from a year ago. Reports are showing that 36% of consumers took on debt during the holiday season. You know, one of the things we've said before, lower income households, they ran through their COVID stimmies years ago and are now they're tapped out. They're starting to take on more debt. And this financial distress has been spreading. And so the delinquencies are up so much, $46 billion in loans were written off in the first 3 quarters of 2024. Based on the charts I'm looking at here, on the credit card loans, it looks like delinquencies from 2.5 years ago were just over 1.5%. They're now over 3%. That is a gigantic increase. On the auto side, it's even worse. Those delinquencies have gone from about 5% to almost 8%. So, Rob, there are a lot of Americans really having a hard time right now, and those problems are going to be pushed on to the lenders and the credit card companies and the financing companies.
Yeah, Gary, you mentioned commercial delinquency rates. Those are at an all-time high of 11%. And then we look at the collateralized mortgage-backed securities. That's rate spiked to 6.6% of delinquencies. And then you also, and I mentioned it in the subheadline, the buy now, pay later loans, those are growing fast as well. How bad is it, Gary, or how bad do you think it is? What is the landscape? What's your message to DKI subscribers?
So let's actually talk about how bad this is. First of all, the CMBSs, the collateralized mortgage-backed securities, if that sounds a little bit familiar to people, those were the financial instruments that blew everybody up in 2008. Now, when you hear 6.6%, is that awful? Yes. And the reason it's awful is because by definition, those securities are leveraged. So it's not 6.6%, it's 6.6% of a gigantic number. There's not enough equity there. And that can cause different tranches, different segments of these securities to go to zero. Office delinquency rates at 11%, that is an all-time high, right? That's not a recent high, that's an all-time high. And buy now, pay later, I've seen estimates that those may be approaching $1 trillion. It's really hard to tell. I'm not entirely certain. But here's the key point. When we see credit card delinquencies starting to spike, and what you realize is that's the high end, the high quality part of it. The buy now, pay later, which is growing really quickly, that's the low end part of it. And just a reminder, last year, they surveyed a bunch of young people, and those people were shocked. They spent money on buy now, pay later, and they were shocked when a month later they started getting bills. Like, how did this happen? Why do we owe money? And they really didn't understand that the store wasn't giving things away for free and the financing company wasn't financing things for free. They were shocked when they got a bill. Now, if people who take things on credit on this buy now, pay later are surprised that they get a bill, Rob, what do you think is going to happen a few months down the road when those bills get too expensive for them?
Gary,
Exactly. And those numbers are not included in the statistics we gave you before. So the point is everything we told you is actually worse than what we're telling you.
Yeah, very interesting, Gary. We'll again keep eyes on this, something we've been talking about. Talking about the collateralized mortgage reminded me of the scene in The Big Short when they explain the 2007 crisis. But anyways,